NUA applies under a few conditions. Number one, you got to have a lot of company stock in your 401k or other accounts at your employer. It allows you to pay the lower long-term capital gains rates instead of ordinary income on a portion of those. You have to decide how to distribute or roll over company stock and retirement plans for tax treatment after tax income. You have to understand the difference between cost basis and market value of the employer stock. So many individuals accumulate stock. This thing's giving me problems. Many folks accumulate company stock within their employer retirement plans. And while these assets may represent a significant portion of their retirement savings, their tax treatment upon distribution can vary greatly. When you use the NUA strategy, you can potentially pay less in taxes. It allows a portion of the gains to be taxed as at potentially lower long-term capital gains rates. The distinction can have a substantial income or impact on after-tax retirement. So if you're nearing retirement or you're just transitioning jobs, these events frequently trigger decisions regarding how the retirement assets should be distributed or rolled over. Most retirees default to rolling funds into an individual retirement account, which preserves tax deferral but results in all future withdrawals being taxed as ordinary income. This approach may not be optimal, especially if you've got a lot of highly appreciated company stock in your plan. NUA measures the increase in employer stock value within a retirement plan at distribution time. It applies to employer stock in qualified plans with specific triggering events and lump sum distributions. It allows cost basis taxation as ordinary income and appreciation tax later as long-term gains. You have to apply to some very specific rules because if you mess it up, you're going to not benefit from any of this. This is unlike most assets within a 401k, which are taxed entirely as ordinary income when withdrawn. Employer stock may qualify for special tax treatment under Internal Revenue Code Section 402E4. This provision allows taxpayers to separate different portions of their retirement assets and how they're taxed, reducing potential overall tax liability. But there's specific requirements that must be met. First, the stock must be employer-issued securities within the 401k, ESOP, or profit-sharing plan. Second, a triggering event must occur, such as separation for service, i.e. changing jobs, reaching age 59 and a half, disability, or death. Third, the distribution must be structured as a lump sum distribution, meaning the entire balance of the plan has to be distributed within a single tax year. Finally, the employer stock must be transferred in kind to a taxable brokerage account rather than rolled into an IRA. When implemented correctly, the NUA creates distinct tax treatment for cost basis, where what the stock costs is taxed as ordinary income at the time of distribution, and the appreciation is taxed later as long-term capital gain, regardless of how long the shares are held after distribution. This allows investors to benefit from potentially lower capital gains rates, which are capped significantly below ordinary income rates. However, strict adherence to IRS rules is essential. Any misstep can cause the strategy to go away completely. Okay, so ideal candidates. Long-term tenured employees with substantial employer stock in their retirement plans. It's relevant during retirement or job transitions when asset decisions are made. It's not ideal for those with minimal stock appreciation or needing immediate liquidity. It's not universally applicable and is most beneficial for a specific group of individuals. Another key factor is timing. NUA generally becomes relevant when a triggering event occurs. Some of these triggering events are retirement, job change, and older than 59 and a half. And then you have to figure out, if it's worth it. Not all situations are ideal for the NUA. If you've got minimal, if you don't have much gain on the employer stock, if you require immediate money, or if you're uncomfortable maintaining a concentrated position in a single stock, may find the strategy less appealing. Additionally, if the stock has been rolled into an IRA, the NUA opportunity is permanently lost. So before you go moving the money out of the 401k or the ESOP or profit sharing plan, you got to know what your options are and how to do them correctly. First, you got to verify the stock qualifies and that a triggering event has to to proceed with the strategy. You got to distribute the entire retirement plan balance within one tax year. So don't go doing this around Thanksgiving or later. It may not happen. Cost basis, it's taxed as ordinary income immediately. Net unrealized appreciation is taxed later as capital gains. And you got to precisely execute this because any deviation from the required steps can cause this whole strategy to go away and you end up paying a lot more taxes. Okay, positive outcomes. There's a tax savings advantage if all the things are fit. Tax timing flexibility. On the capital gains, you may end up choosing when you do it. And a partial diversification benefit. A primary advantage of this strategy lies within its ability to convert what would otherwise be ordinary income into long-term capital gains. Capital gains are generally lower than ordinary income rates, and this can result in meaningful tax savings, particularly if you're in a higher tax bracket. Okay, but there's some negative sides to this. Concentration risk. Holding a large portion of your wealth in a single stock exposes you to company-specific market risk. Immediate tax liability. You do this, you're going to have a tax bill pretty much immediately. Execution sensitivity. If you don't do this just right, it can cause problems. Additional tax consequences like state taxes, net investment income tax, and no step up in basis at death add complexity to the planning. So you got to verify your eligibility. Got to make sure they qualify as employer securities and that a triggering event has occurred to meet IRS rules. Then you got to determine the cost basis because it may be that you're not going to benefit enough from it. Then you got to coordinate the lump sum distribution. Got to make sure not only do you get the stock out into a brokerage account, but all the rest of it makes it out into a rollover IRA before the end of the tax year. And you have to manage the stock with diversification, with timing and considerations while collaborating with both financial and tax advisors. Okay, if you roll the stock into an IRA before evaluating NUA, that this strategy is permanently gone. If you don't make all the rollovers into an IRA, it's gone. And if you make a mistake on your cost basis, that could cost you too. And lack of professional coordination. Both your financial advisor and your tax person have to be involved. Quick scenario. I got a guy with 300,000 taxes ordinary income at the 32% tax rate if you just put it all into the IRA, and you get about 96,000 on tax liability upon withdrawal. If you do it in an NUA, you have 60,000 cost basis. That's how much the stock cost inside the plan. So you get 240,000 appreciated value taxed later at 15% capital gains rate. And the strategy results in $55,200, saving about $40,800 compared to doing an IRA rollover. Financial advisors evaluate the strategy with investment goals, analyze risk, and develop diversification plans. Tax professionals verify cost basis, model tax impacts, ensure IRS compliant managed tax reporting. Collaboration ensures comprehensive planning, informed decisions, and help avoid costly errors in the NUA strategy. It can provide significant tax savings, but requires understanding and professional guidance. Once you graduate, be it from welding school, engineering school, or law school, you're going to need a different plan for each of these stages that's tailored to your individual situation. During your working years, am I saving enough and is it in the right place? Glide path to retirement, which I label the last 10 years prior to retirement. Will the USS retirement be shipshape on the appointed day? Retirement. How do I avoid running out of money before I run out of life? And legacy. Does what I worked hard for get to where I wanted it to after I'm done with retirement? I can be reached at herwirefinancial.com. I do in-person, Zoom, and phone appointments. I am licensed and registered across several states and can easily add states if there's a need. If you'd like to schedule an appointment, you can click on the schedule an appointment button in the upper right-hand corner of my website. Want to see more videos like this? Go to my website and click on the YouTube button. It's that red button, few over from the schedule an appointment button. If your friends want more information, they can follow me on LinkedIn, Facebook, Twitter, and like and subscribe to my YouTube channel. For those who prefer the good old-fashioned telephone, 518-631-2569. Do not text that number. We'll both be sad because I won't get it. There's a separate texting number there. Opinions voiced in this material are for general information only, not intended to provide specific advice or recommendations for any individual. All performance reference is historical. No guarantee of future results. All indices are unmanaged and may not be invested in directly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax or legal advice. Consult your advisor prior to taking any action. This information is intended to be educational, not tailored to the investment needs of any specific investor. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All right, everybody, have a terrific day. See you next time.